Hello and welcome to another edition of the How to Grow Your E-commerce Business podcast. I'm here with Chris Grove from Archer Fleming, and we're going to talk about broadly speaking finance for e-commerce companies. Hello, Chris, and welcome to the podcast. Tell us a little bit about yourself and your business.
Hi, Trevor. Thanks very much indeed for having me on. So I am a corporate finance professional. Effectively, my business, Archer Fleming, what we do is we help people find investment or we help people exit. And that is typically founders or families who own businesses rather than big corporate carve-outs or private equity sales. We sell a lot of business to a private equity, but we don't work for private equity. So we work for individuals who are looking at either that exit or they're looking to help their business grow with some injection of capital.
So, what kind of kind of companies are what kind of stage are companies when they come to you, and what do they need? What do they need to have got right first?
So it's a very interesting question. The kind of companies that we typically help, it's probably easier to talk about an enterprise value, as in what they are worth, as to when we can start helping. And typically for me, that enterprise value number is probably around 10 million. Now, most companies who are below that level will still need financing, and I can definitely offer some advice and tips and things that you should be thinking about on those smaller entities. My own company typically works on businesses from sort of 10 million to 100 million pounds.
So what's that? How's that value calculated?
Well, that's a very good question as well. So
maybe we'll come back.
Valuing it.
Jumping ahead of ourselves.
I'm happy to. Now we can come back to it. It's up to you.
Yeah, let's do that first. Yeah, how's that calculated?
Let's do that first. So again, let's look at company size, because the size of the company matters as to regards to the valuation. So there's a few different methods of valuation. And like any company, it's usually either a multiple of the EBITDA of the business or it's potentially a multiple of the revenue of the business. The smaller the company, the lower those multiples tend to be. So if you are a £500,000 revenue business with not much in the way of EBITDA, then it's unlikely that you're going to achieve a very high multiple. The larger the company gets, the higher that multiple might become. And indeed, actually, sometimes rather than an EBITDA multiple, especially in e-commerce, it can be a multiple of revenue. And ultimately, you'll find valuations aren't quite what they were 5 years ago. They have dipped in the last few years, but we're still seeing some really strong valuations. So, for instance, I was having a conversation a few weeks ago with a company in this space. It's a food business, great diversification of where they sell. They're on various different sites. They've got a very good EBITDA. The revenue is north of 10 million. That kind of company can easily be worth 2 to 3 times their revenue. However, a lot of valuation comes down to looking for red flags to find ways to chip away at that valuation. So, for instance, if your entire business is on Amazon, because you only have effectively one route to market, then that business is inherently worth less than a business that might be on Amazon, Shopify, and however many other channels there are out there. So the more diversification a business has, the more the better the quality of earnings. So, for instance, subscription is far better than individual sales. The better the quality of earnings, the better the revenue model, the more the diversification, the higher up that valuation arc you might get to. So it's perfectly possible to have businesses worth 2, 3, 4, 5x revenue, but they tend to be businesses that have a great niche, that are diversified, that have brilliant quality of earnings, and also, frankly, that are very well-run businesses. The logistics are sorted out. There's no issues with any of that. The numbers are all there, ready to look at. They've got access to financial information. The governance structures are in place. All these things contribute to that business being more valuable than the business that doesn't have those things.
Okay, so you should do things like, you should diversify the channels you sell on. You should do things, I'm guessing, like have an email list so you get repeat customers, Subscriptions are
Absolutely.
great.
Yep.
Make sure that you've got high quality financial, got good accounts. Um,
Yep.
so okay, so that makes sense. So at what point? I mean, imagine I'm a retailer, right? At what point should I be thinking? I'm chugging along nicely. At what point? What would be the flags that I would look at, which say I would benefit? I could grow more quickly if I got some funding.
So that is a very good question. Actually, I think that there are a few different things that are usually starting to be a problem, and size and scale start showing problems quite quickly. So logistics issues: are you actually able to fulfill all your orders in the time and the fashion that you expect to do so? Is your growth, while being a fantastic thing, is that growth actually coming at a cost, and is that cost that ultimately, if you keep growing at this rate, you won't keep up with the level of growth that you have? It's those kind of questions that generally mean investors are really interested. Now,
Okay.
investors can still be interested if you go to them and say, well, actually, look, I think I can double my revenue if I just have better sales and marketing. That's great. And investors are still going to be interested in that. But that real growth story around, actually, we can no longer afford our own level of growth, that's when you have investors queuing up and actually fighting over investing in you. So
Okay.
there is a difference between those two scenarios, and investors are very keen on finding those kind of businesses, and they do exist. We've done multiple deals with businesses who genuinely just need the cash through the door because they've started getting to the point they can't afford that growth already. Um,
Okay.
they're the really great businesses out there.
Okay. So what kind of? I mean, what are the funding options available? So we'll get to that point. What are the funding options available?
So again, let's split this into size of company because it does matter. So if you are, let's say your revenue is less than 1 million, let's say your enterprise value is probably less than 2 million. Funding options in the UK, I'll talk about the UK in particular, and I'll talk about other countries. Funding options in the UK really at that level are family and friends. It's who do you know, who's likely to do it, angel networks, things like that, especially if you can offer SEIS or EIS, which de-risks that investment somewhat for people. That's really the only option at that level. Once you start looking for between 1 and 5 million, I'm going to be a little bit negative about the UK here. The infrastructure is poor for finding that level of money. It's the hardest money that you will ever raise in businesses, between 1 and 5 million pounds. There are lots of venture capital businesses out there that you can approach, but it is hard. It is very difficult to raise that sort of money in the UK. And actually, there are lots of American funds that will look at the UK, as lots of European funds, but that is the hardest level of investment that you'll find. Once you're above sort of 5 to 10 million pounds of enterprise value, the UK comes into its own at that point. There is a huge network of private equity type businesses out there who are looking to invest in growing businesses. There's lots of conditions attached to that investment, obviously, and a lot of them will want to take a majority stake rather than a minority stake. But actually, there is a massively good ecosystem of private equity across the UK.
Hmm.
Not only that, there are family offices. So family offices, slightly different to private equity. Family offices effectively are a wealthy family who have an office that invest in things that they are interested in. Now, those businesses, they're not about wealth creation. That family's already made that money. They're about wealth preservation. So they look for interesting opportunities, but they tend to be a bit more long term. Where private equity might come in, and we do a lot with private equity, they might look to sell your business within 3 to 5 years of investment. They'll want to grow it very quickly. A family office is much happier to be saying, actually, we might hold on to these shares for 5 years or 10 years or 15 years. They've got a much more long-term mindset as a general rule.
Hmm.
The US is slightly different to this in that they have slightly better, probably significantly better, if I'm being honest, ecosystem of investment available for people looking for 1 to 5 million.
Mm.
Um, it's a bigger economy. It's a larger country. There are lots of investors out there that will look at those sort of levels and will have, to be completely frank, a better handle of risk appetite, and so therefore are more likely to invest in smaller things. You have to remember most investors that invest in small things are expecting quite a high failure rate.
Hmm.
It's one of those things, especially in the venture capital end of the market, there is a high failure rate, and they're expecting that 6, 7, 8 of those businesses out of 10 might fail. And so
Okay.
therefore, the ones that they back that do really well, they're expecting to do 5x, 10x, 20x their money, and they'll make a lot of money back at the back end.
Okay. But if you've got a business which is already, I mean, so I look at a business turning over 10 million quid and thinks that's already quite a successful business.
It is.
Is it
It
is
is.
it the case? Is it the case that if those businesses fail, they take on funding and they kind of grow too quickly and fail, or is it they?
So if it's above 10 million, yeah, there is much less of an assumption that business will fail. The bigger risk of the private equity style larger investments on 10 million plus enterprise value, the bigger risk, frankly, is stagnation. That's the larger risk. Private equity still want to see 2, 3, 4, 5 times their return in 3 to 5 years, and they still want to plough money into it. But the bigger risk for them is generally stagnation rather than bankruptcy at that point.
So it doesn't actually just doesn't achieve the valuation they expected it to.
Exactly, exactly. And bear in mind, private equity, they aren't the people that own the money that they're investing. They're taking fees themselves. So in order to generate their fees, they have to be successful with what they're doing.
Yeah.
So therefore, with private equity, it's very much around that they'll back you, they'll put the money in, but they want to see high return for that money. And often that is in organic growth as well. They want you to be out there buying companies. They want you to be consolidating that market. They want to be out there really doing as much as humanly possible to guarantee that return that they're after.
Okay. So how do you got? So we were talking about the different funding options. Have you covered that or?
Yeah, I think that's mostly covered. I think that, so the main ones that we talked about, family and friends, most small businesses, that's where it is. It's those initial top types. I think between 1 and 5 million, it's venture capital. It's those kind of people. There's lots of them out there. And then above 5 to 10 million pounds, you're into the territory of private equity and family offices. The one thing I haven't mentioned, which is worth touching on briefly, is of course debt. Um,
Yeah.
the one thing that you find difficult, though, as smaller companies, is the cost of that debt. It's unlikely that if you're a small company, the bank is going to offer you the kind of debt that would be useful or the amount of debt that would be useful, which means you start going into the sort of the mid-market or even venture debt. And the mid-market, you're probably talking 6 to 8% at the very lowest on interest, but potentially 10, 12, 14%. And venture
Because it's
debt,
so risky.
because it's risky, and venture debt can be 20% plus in certain cases,
Credit
which,
card levels of
yeah,
of
credit card, which is terrifying. You know, if you're a small business with thin margins and you're borrowing at 20%, I mean, that's horrendously expensive. Debt has its place, don't get me wrong, especially with, there's all sorts of the invoice factoring type things, which is much more difficult in e-commerce, but debt's a difficult one if you aren't on decent margins.
Okay. So what is the market like at the moment for brands? Because I know it was a big after COVID, there was a big kind of boom and everyone was trying to buy e-commerce brands. What's it like now?
Um, it is not as it's not as good as it was. So post COVID, 22, 23, it was very, very strong. There were a lot of businesses for sale. Valuations were very high. There has been a bit of a correction in valuations, and there has been a slight slowdown. Now, I'm not saying that the market is dead. It absolutely isn't. In fact, we're working at the moment with a couple of e-commerce brands on raising money, and there's lots of interest in both of them. So the market is absolutely not dead, but it would be wrong to expect it to be where it was in 22. It isn't. And I think the other thing that is really important for people to be aware of, a lot of people took investment on, let's say 3 or 4 years ago, and there was an expectation that, let's call that a Series A raise, that a Series B raise would be possible in 3, 4, 5 years. That is much harder than it used to be. Series B is very, very tough unless you have a profitable business. So there is a much stronger focus now on EBITDA than there ever used to be. At one
Could
point,
you
there was
explain? Sorry, you've been using. I meant to ask you. Could you explain EBITDA?
oh, sorry, yeah, it's effectively profitability after things like depreciation, amortization, everything else. So at one point, there were a lot of people who were being very much focused by their investors on revenue over anything else, especially in, I'm going to go back to a slightly adjacent sector here. So especially in things like software and things with subscription models, it was build revenue. We don't care about profitability. That has disappeared. Profitability now, having a good net profit margin is something that is vital. It's absolutely vital in order to pick up secondary stages funding like Series Bs. People want to see a company has a genuine ability to make money, not just revenue. And so profitability is a huge part of valuation now in e-commerce, whereas, okay, it's not quite the same thing as being in software where, you could be making a massive loss and still get to the point of making a load of money on exits. It was never quite like that in e-commerce, but there is a much bigger focus on profitability than there ever has been now. And indeed, a lot of valuations now are multiples of EBITDA rather than revenue, specifically in this space. But
Okay.
there are so many dependent factors upon what sort of e-commerce it is, and all sorts of factors around what red flags there are in the business. There's a million questions. It's so hard to deal in generalities.
So what is the okay? So what can you do to maximize your valuation? You talked about the red flags. I'm guessing part of that is getting rid of those
Yep.
red flags. But what? Talk me about maximizing. If it was a
Uh,
house, you'd go in and you'd kind of tidy it up a bit, and what would you
yep.
do in an e-commerce business?
So the first, I'm going to talk about a couple of things that may be a little bit controversial here, but it's absolutely true. So first of all, let's talk about your accounts. Having someone who isn't just an outsourced accountant looking after your account is absolutely vital. So when you go through a sales process or an investment process, one of the things you're going to have to get through is due diligence. And if you go into due diligence with an inability to produce the numbers that the buyer expects to see, you're going to have a much harder time. So if you have access to all these numbers from day one, and I'm talking about not just your statutory accounts, having an annual budget that you can produce, having management accounts that you can produce, having a business plan that you can produce, having all these things to hand that shows how well the business is run,
Mm-hmm.
it's incredibly helpful, not just in terms of evaluation, but in terms of getting through a due diligence process. One of the most vital things that you can do. And actually, if you're a big enough business, having whether it's a full-time or a part-time CFO in the business, that is a huge added benefit, not just from a day-to-day basis, but from every other benefit as well. So financial information, hugely important. And yet I would say that's coming from a corporate finance background, but it's hugely important for a deal. The second thing is corporate governance. And again, it's one of those things that a lot of people look at as a box ticking exercise. But again, if you're going through a due diligence process and someone says, well, hold on, why did you make that decision? Why are you doing this? How has this happened? If you can then produce a board paper that said, well, we discussed this at board level. The reason that we did this is X, Y, Z. We have a whole chain of documents that back up why we came to the decision of what we did. Again, it makes your due diligence process a lot easier. It's a very straightforward process if there's a clear line of sight through all the decisions that you've made in the business to that point. A well-run business is so much easier to sell than a business that isn't quite so well run. And let's be honest, a lot of businesses, and I've ran multiple businesses, not just the one I'm in, a lot of businesses are very much based around a founder. And
Yeah.
if it's that person's head, it's a lot less valuable than if you have a team of people, a management team, an independent board, people that are reviewing those decisions, and there's a reason why those decisions have happened. It really does make a big difference. And then there's all the other obvious things. Keeping the numbers completely clean. I mean, look, this is really going back to basics here, but you still see it all the time. Founders who are putting through some of their personal expenses through businesses or putting through cash through their own business. It's an absolute killer on evaluation. The last thing you should be doing is putting anything through the business. You want those numbers as clean as a whistle for when you're doing investments. And
How long do people look back through the books for that kind of thing?
usually 2 to 3 years. 2 to 3 years
Okay.
is right, but not in e-commerce. I have to. E-commerce is generally better than this. But I mean, I've seen people build their house extension through the books before. I mean, things like this, and it's crazy because ultimately, clearly it's against tax rules and everything else, but you're knocking your own valuation down. If your valuation is 6 times EBITDA and you've just knocked off a load of for your EBITDA, then it's ridiculous.
That house extension is costing you 100 grand times 6 or
Yeah,
something.
that's it. Exactly that. And yet people still do it. You see it all the time. So those books need to be clean as a whistle. And then everything else is really, I would say, is back to operational, the operational side of the business. It's how do you how how well is your business built? So do you have a management team that if you were thrown under a bus, can they look after the business? If something happens to you, God forbid, does the business keep going? That's a big tick in a box there that says, yep, the business is built to run without me. So having founder risk there is an issue. Client concentration risk, or in this case, channel concentration risk. You can't just be on Amazon for the sake of argument.
Yeah, Amazon. I mean, because what I do on a day-to-day basis is help people with Amazon, and they can and will just shut accounts down.
Yep, and
And
I've seen this before. Yeah,
it's a nightmare.
it is.
So,
So that diversification is huge. And again, back to quality of earnings. You can say, well, yeah, we have a subscription model, or we have this amount of repeat custom. Fantastic. It's far better than just a lot of individual smaller sales. You want repeat custom.
so perhaps, I mean, what is the process of going through, maybe from start to finish, in getting funding? And perhaps you could, I don't know, I don't know if you can use names a lot, but just give an example as well of a company that went through the process.
Um, I'm always a little bit careful about naming names. Look, if anyone
Or
wants to
just give a generic company then. Just
yeah,
a company A.
you could, there's a few press releases on our website. You'll see some of what we've done. So there is stuff there. The only reason I'm careful about naming names is because there's always a skeleton, or there's always been a problem or there's always been something. And I hate to throw anyone under the bus with a story that says
Just anonymize
yeah.
and combine data into a yeah.
Yeah.
But what would be a typical process?
So a typical process, I'll use a bigger company just 'cause it's more in my wheelhouse to do the bigger company stuff. So let's say you employ someone like me to come and find you an investment. And let's say that your business is going great guns and you need money because frankly you're growing and you just can't afford that growth anymore. So we come in and we look through the business and we have what's called the discovery period. And that discovery period is effectively, it's going through all the questions we just talked about to come up with the valuation. And one of the most important parts of my job is those early days where it is, we need to agree with the valuation that the vendor has in mind. And a lot of the time, there can be a discrepancy between those two numbers. We'll come with a market valuation that is rooted in the numbers that we see in the market recently. Sometimes vendors might have a slightly inflated sense of what that valuation is. If they have a number in mind that is way above where the market thinks it is, there is no point in me going to market with that business. So the first thing that we do is we agree where the valuation is. There are two really important parts to that. One is we need to find what we would call a maintainable EBITDA, which is an underlying profitability. Do we agree with their number of what that profitability is? So there are things that you can add back into profitability to come up with that number. The second number is the multiple. So what do we think the multiple is? Once we've done the discovery period, we move into creating one or two documents, and it depends what we're doing at the time. If it's an exit, it's an information memorandum. If we're looking for investment, it's an investor deck. So we come up with a copy of that. We probably spend the first 6 to 8 weeks of a process doing the discovery, coming up with the investor deck, getting it to a point where everybody's happy with it. Our processes then were incredibly targeted. We will go, especially if it's private equity, despite the fact there are probably well over 3,000 of them, we will probably go and speak to 20 or 30 where we think that we already know those guys. We've done deals with them before. We understand what they're looking for, and we think they'd have a genuine interest. We have a proper conversation with them, probably over the phone initially, and then we go and introduce them, assuming they're interested, to the owner of the business. There's a long conversation at that point that happens, probably 2 or 3 meetings, and then we invite offers for investment. And ideally, your absolute ideal, if you can do it, is you want some competitive tension. You want multiple parties that are interested, and you want several different offers. We then sit down, we discuss the offers with the owner of the business. We decide which one to go for. And by the way, that is frequently not the case, that it's just the one with the best valuation. Because if you are taking on an investment, you want to be absolutely certain that your investment partner is somebody that A, you feel you can work with, and B, isn't going to annoy you, and that your values, all of this is aligned. I say that frivolously, but honestly, if you're a 50-year-old businessman that's done this 2 or 3 times, and they're a relatively young PE firm, they put a 25-year-old MBA on your board, it's going to drive you mad. So it's got to be somebody that there's a cultural alignment, that you believe in each other, that they're the right partner, and therefore it's the right investment. And actually, the number at the end of it really sometimes isn't the issue. It's all those slightly more fluffy things. So
Yeah.
once you've agreed that investment, at that point it's off to the lawyers and it's off to the due diligence. And we help you through the due diligence. We go all the way through that process with you. We're able to do due diligence ourselves. I tend not to do due diligence reports. I like doing deals, but we help you through that process. We anything that you need during that, we look after. We also project manage the legal side of things in terms of just looking after everything to make sure that the SPA or whatever it is that's being drafted is drafted correctly. And eventually we get to the point of the investment happening. Now, timeframes, for a reasonable sized deal, let's say a £10 million plus enterprise value business, it's probably a 6-month process. And it's not an easy process either. It's quite grueling. There's lots of questions to be answered. Any little skeleton, red flag, anything is going to come up in due diligence. We have to go through all that and have some quite frank conversations and sort those things out. A lot of people get very disheartened. There's a thing that we talk about a lot called deal fatigue, and it's where you get towards the end of a deal, you're sort of 3 weeks, 6 weeks away from it, and all of a sudden you feel like you're being pickpocketed at every single point. You feel like there's things going wrong everywhere. That's the real danger zone of any deal.
I'm guessing it's quite an expensive process. Lawyers are expensive. I guess you don't work for free, et cetera, et cetera.
Oh, no. I mean, we charge, I'm always open about this, we charge 3% of the amount that's invested, whatever that amount happens to be. We're not trying to do it. I know some people charge on enterprise value. We don't. So it's not a cheap process. The lawyers, I mean, on a 30, well, sorry, let's do an easy maths. On a £20 million transactions, we're going to be charging 600,000. Your lawyer's probably going to charge you a couple of 100,000. It's not a cheap process to go through, but ultimately, you're hopefully going to come in with a partner who is going to be massively helpful in building your business and growing it as quick as humanly possible, but in the right way. You may be able to take some cash off the table. Even if it's an investment, it may be the case that, let's say, X million goes into the business, but you also take some money off the table and X million goes into your pocket. So actually, you are making some cash out of this yourself as well, but you're de-risking your own investment. And of course, the other thing is that, let's say you've done this transaction now, but the plan is that in 3 to 5 years there's going to be another event. Well, that event in 3 to 5 years' time may well give you more personal cash than this one did. So you may well make far more money in 3 to 5 years than you did this time around. This is all very slightly different if it's a smaller business, by the way. So if it is a smaller business, you're probably not taking money off the table. You're probably not necessarily giving away a majority stake. It might be a minority stake, but the process roughly goes in the same way. It might be a bit quicker. The stars align and everything else, and you can get through legals. It might be 4 or 5 months, or even 3 at a real push. My own personal record for a small investment of 1.5 million was less than 24 hours, but that is It's
That's a good
honestly,
effort. Not much
it's
sleep in that period.
never happened before or since, I can tell you, but mostly you're talking in the months.
Okay.
So, but that's a fairly typical sort of track as
Okay.
to how it's to go.
So let's talk a bit about acquiring other businesses. So I mean, under what circumstances would be, firstly, is it a, have you, is that a good idea? Um,
Mhm.
what's, just talk us through, some of the considerations around that.
So, is it a good idea? Is a very good question. I mean, look, ultimately, it'd be hard for me to sit here and say it's not, given this is what I do for a living, right? But there are lots of consolidation businesses out there. This is all they do. They go and buy other businesses, squash them together, and create a new thing. And ultimately, what they are relying on is something called multiple arbitrage. So they are buying businesses, let's say, at 3 to 5 times net profit, and they are valuing themselves at 10 to 15 times net profit. So every time they buy a business with $1 million of EBITDA, instead of they buy it at 5 million on their balance sheet, all of a sudden that 1 million is worth 10. So they've made 5 million out of thin air. That's what they're looking to do. There are, though, massive pitfalls to buying businesses, depending on the sector that you're in. So, is it guaranteed that you buy a business with £1 million of profitability, that £1 million will go straight to your bottom line? Absolutely not. There's all sorts of reasons why that may not happen. First of all, you've got to integrate that business into your business. And let's be honest, that can be a painful process. You've got to take on board their staff, some of whom might not wish to go with the business. You may well lose people. If you lose people, does the business lose momentum? There's lots of factors around that integration piece that can be quite difficult and painful. The overriding argument for most people when they're buying a business, especially if it's a strategic acquire, if you're a strategic acquirer looking to buy a business, is you think, well, I can remove some of those group costs. So, for instance, I'm a bigger business. They have a finance person. I've already got a finance person. I can make that person redundant. I don't need them. I don't need their HR person. I don't need their etc. etc. And so the prevailing logic is, well, I can cut some costs, and that £1 million EBITDA business becomes a £1.3 million EBITDA business. What it doesn't take into account is the costs of integration, especially in the modern sort of digital age. If you're, sake of argument, your CRM systems are different. Well, how easy is it to integrate those CRM systems? How does that work? If your finance systems are different, how can you integrate finance systems? There's lots of pinch points where there are problems, and you can't just squash a thing together. And some of those things come at a cost. And unfortunately, that's the cost of inorganic growth.
And not
So,
just time, it's time as well as and
oh,
attention, I suppose, as money.
absolutely. And especially from the point of view of the CEO doing it, because all of a sudden you've got a load of new staff, you've got this new shiny thing, which is fantastic, but it's going to take up a huge amount of your time. You're going to take the eye slightly off the ball from the day to day business as usual stuff. So you have to weigh up all these things. And the big question is, will this acquisition move the needle enough that it makes the acquisition worthwhile? So if you were a business that's doing £5 million EBITDA, and somebody comes along and there's a really nice little business, but you're only doing £200,000 EBITDA, well, it's not big enough to make a difference to your business. So the amount of hassle and cost and problems that will come in such a small acquisition versus the size and scale of your business, it's just not worth doing. And don't forget, you've got your own professional services fees. You're going to have advisor fees, due diligence fees, lawyers fees. All these things add up during the acquisition on top of the amount that you pay for the business. And so therefore you have to be very careful when you're looking at a business, is this genuinely worth it? You've got all the cost of money, but then you've got the cost of time. It's all those things. And if it genuinely is worth it, I've seen great acquisitions. Obviously, this is what I do. I've seen lots of people make lots of money on inorganic acquisition. But you have to be very careful what you're doing, especially if it's the first time. And honestly, and I would say, because I'm an advisor, you need the right advice. Don't just go into this and do it on your own. at least have someone sense check it, at least have someone do the due diligence for you, both commercial and financial. But really have somebody have a look at this that is separate to the two businesses. Really get under the skin of the thing.
So what are the funding if you just do decide you've got a good acquisition? What are the funding options?
Again, let's go back to debt. Debt's the first one that is worth having a look at. Typically on debt, and look, this is a bit of a moving feast, and I am not a debt advisor guy, but typically 2 to 2.5 times EBITDA is possible on debt. Generally, maybe a little bit more, maybe a little bit less, depending on the funding cycle. On a good business, so debt is something you should absolutely be thinking about when you buy a business. The second option is it's very rare that somebody could, let's say a business is worth, again, sake of maths, £10 million. It's very rare that you give that person £10 million and they walk away. So the reason being, you want to know that the business is as good as you think it is. And so typically you'll be saying to the person that owns that business, look, we'll give you 70% up front, but I want to pay you 30%, some element of deferred consideration over a period of 1, 2, or 3 years, whatever that number happens to be, because you believe in your business, and therefore you believe that it'll keep hitting the numbers, and therefore you should allow me some level of deferred consideration. Almost every deal I've ever been involved in has had some level of deferred consideration attached. So effectively, you're not buying 100% on day one; you're buying 70. Well, I'll be technical. You are buying 100% on day one, but you're only paying for 70%.
Right, yeah.
So if you then work out the maths and say, right, that business was worth 5x EBITDA. So you've got a £2 million business, a £2 million EBITDA business worth £10 million. You're able to do roughly 4 or 5 million of debt. You're able to defer 3 million elsewhere, which means you've got to then fund the difference. So you're looking for £2 or £3 million. And that can be brought in via investment. So you could have a private equity or a family office invest in you. Obviously, you might do some of that out of your own cash flow. There's lots of ways of doing that. But the deal, if you're bringing on outside investment in order to do that deal, clearly the deal has to stack up. And again, if you're talking millions of pounds here, you need advice along the way. You need a proper debt guy that's going to come in and explain all the debt side of things. You need a financial guy like us to come in and look at, do due diligence and everything else. You really need to get under the skin of that business when you're spending that level of money. And the investors who back you to do it will expect to see it, and they will do their own due diligence as well.
Okay.
But absolutely go to market for investment for those kind of deals.
Okay. So what is I'm just trying just to kind of sum up, what are the 5 things that, if you're a company that thinks they need some investment or starting to think about investment, what are the 5 things they need to be thinking about? The 5, we could go more than 5.
I could probably go about 25.
Oh, fine. Let's as many as you like.
Well, no, I'll stick to 5. So I think if you're going for investment yourself, the main thing that you should absolutely think about to start with is your own financials. You should be looking at those and making sure they are squeaky clean and that you have access to all of it, and that the business is ran financially in a way that an investor would want to see. So that's the first thing. The second thing, and we haven't really talked about this, but it's absolutely critical, is business plan. Effectively, they need to know, if you're sat there as an investor and you're thinking, well, I'm going to put 5 million, 10 million, 20 million pounds into this business, what am I getting for my money? So you can see absolutely where the business is now, but you want to know what they're going to spend that money on and how they're going to achieve that growth. And so the business plan side of things is absolutely critical. And whether you call that a business plan or an investor deck or whatever it is, they want to see how are you going to spend that money, but then they also want to see how they're going to get their money back. So what's the return on
An
that?
exit plan.
An exit plan as well. And that forms, if you're writing investor deck, the exit plan should be in that investor deck. You should be looking at what that secondary exit is, and there's a plan from A to B. This is your investment now to the B part, which is the exit down the line. So investors want to see exactly that side of things. I'd be looking at my own internal governance structures and making sure all that is sound. I think that is well worth doing. I'd be tidying absolutely everything up so that there were no major loose ends. I go back to all things we talked about earlier. Make sure there are no red flags in the business. Make sure everything is ticking over as you'd expect it to do. And I think that the last part of that is looking at the management team and are you happy with the people around you? If you are hit by a bus, can they pick this business up and continue on exactly as you were when you were here? The management team is absolutely critical because, again, founder risk. If 60% of that business is in your head and you're hit by a bus and they've invested in you, all of a sudden they've lost a big chunk of that investment. So therefore, it has to be within the business, within the management team, not sat with the founder. So those are the critical aspects, I think. But I think the other thing is really come and have a chat with people like me. I mean, we're always happy to talk about this for free and sit and go through this as long as people want. Because from our point of view, it builds relationships. And to be honest, I want people to come to me already in a state where it's investable. I don't want to have to say to people, you're a year away or you're 2 years away. You're not where you think you are. I'd much prefer to be saying to people, it's fantastic. Let's go to market. We can help you do this right this very minute. That's great for us. But as it stands, most of the time, what we try and do is get there 2 years in advance so we can help people get to that point. Because the longer, the more access we have to them, the more we can help. There's no charge to that. It's just we'll help you because it means that I've got a potential sale pipeline 2 years down the line. Delighted to do. So actually, we're very happy to meet companies at an earlier stage than I've talked about.
Okay. That's very interesting. I've got just one final question for you. I'd like to ask a fluffy question at the end. When you're not thinking about M&A, what do you do yourself? What's inspired you recently? Tell us something fun you've done recently, or
well, fun things recently. I'm just back from a holiday in Morocco, but which is fantastic, by the way. But I would say that the things that I do outside of M&A, I definitely have a few hobbies. So I play paddle, which is really interesting.
paddleboard as in like tennis kind of thing.
Like tennis, exactly that.
Yeah.
So recently, well, say recently, I've been doing it for about 3 or 4 years now. Absolutely love it. It's been brilliant. I also sadly cook a lot, which my wife is she keeps telling me she keeps putting weight on, so that's not great. But I love cooking, and I'm a massive petrol head, so cars. So
Okay.
yeah,
A petrol head, a cook, a petrol head.
absolutely.
Okay, go through these in order then, right? Okay, so paddle. Why would I play paddle as opposed to play tennis?
Oh, frankly, I'm too old for tennis.
Tennis is hard. Tennis is a hard game. I mean,
So hard.
I
I,
played
I,
I played badminton, which is a lot easier to get going on. I think it's a
yeah,
lot
I
easier
would.
to play.
We got into tennis. So I work in London, but I live in Portugal. So I live in Lisbon, and paddle is everywhere here. So is tennis, to be fair. But my wife decided we needed a sport, so we tried paddle. And actually, a week ago, we went for our first tennis lessons. We both said, we've never played. We should try tennis. Will we enjoy it? The most tiring thing that I've ever done. Because paddle is basically, if the ball hits the glass, you've got another chance. It comes back at you. It's fantastic. Whereas in tennis, you just have to run after it, and it's just I was exhausted.
Yeah, I think with tennis is. I think having played, I think that badminton. It's something like badminton. I think you can actually to pitch badminton. You
Mm,
can you can play it a lot better as a beginner. I think
yeah.
than than and you can get going really quickly. Whereas with tennis, I just think it's just hard
Oh,
to.
it is. It is. I mean, it does feel very different to paddle. I hadn't realised that the big difference that I didn't expect. I didn't realise the tennis racket was about sort of 6 to 8 inches longer than the paddle racket, and so where I was stood in order to hit the ball for tennis was completely wrong, and I was sort of having to adjust mid-step every time, and it's very different. I do agree about. I used to play badminton 25, 30 years ago at school occasionally, and I did quite enjoy badminton actually, but I never thought about taking it up.
Well, if you're
Essentially,
in Lisbon, you want to be outside. I would have thought.
yes. Although I'm saying that the problem in summer, of course, is you get burnt, and being a pasty a pasty white Yorkshireman, I come off the court looking like a lobster. So
Should
yeah.
put some sun cream in. So okay, so that's the first one. Okay, so cooking. Right, I don't know. What kind of food do you cook?
Um, Anything and everything. To be honest, my wife is Asian, and we do a lot of Asian food. So this sounds ridiculously profligate, but it wasn't that expensive. We imported a wok burner from China because the hob at home is just not hot enough to do proper Chinese food. But yeah, I love looking at videos online of genuine, authentic, especially Szechuan or places like that. Just authentic Chinese cooking.
Because most Chinese, I mean, like Chinese takeaways in the UK are nothing like proper Chinese
Oh
food,
no,
aren't they?
not at all. No,
Not even a resemblance, almost.
no. I mean, to be fair, I mean, I've travelled around Asia quite a bit, and there are much worse. I have to say, there are much worse Chinese food than in the UK. I mean, honestly, Chinese food in Spain, if you've ever had it, is appalling. But no, there is a big difference. And to be honest, I really like Szechuan style. I really like hot and spicy and lots of chilies and that sort of thing. But we've tried all sorts of. I love finding new regional things, and so we recently did. We recently called I can't pronounce this. So I'm going to apologise to any Chinese people listening, but a xian bing, which is it's sort of like a fried pastry with spicy beef inside from the city of Xi'an, and it's absolutely fantastic. It's a pain in the backside to make them. And Esther, despite being Chinese, has never eaten one in her life until I made one. But they're fantastic.
Oh, so like you had this, you thought, where have you been my entire life?
Absolutely.
I do.
It's brilliant. It took me about 3 hours to make the damn things, but they're fantastic. You know, always loved cooking. I've cooked for years, but I have genuine passion for Asian food. So
Okay, so petrol. Okay, so favorite car. What's your favorite motor then?
oh, Jaguar D-Type by a long way, but I'll never be able to afford one. It's,
Okay, so what's the favorite car that you own then? How many cars do you have?
I have got 3 at the moment. I have dropped that down. It used to be more. The favorite car that I own, if I didn't say this, my kids would kill me. We have a Camaro, a Chevrolet Camaro, which is the same as Bumblebee in the films, and it is the limited edition. It looks exactly like Bumblebee in the films, but
What's
it's
Bumblebee? So I know that.
oh, from Transformers. Oh,
Oh, right. Okay, right.
you have to go watch the Transformers film now. No, so it's a 6.3 liter V8 muscle car basically, and it's been very heavily modified. It's 650 horsepower or something, and yeah, it's ridiculous.
Not very environmentally friendly then.
No, 7 miles to the gallon. It's ridiculous, but I'd say it only goes out once or twice a week because it doesn't have air conditioning. When they modified the engine, there wasn't enough room left in the bay for the air conditioning, and so therefore in Portugal that's a problem. But
how hot's it in Portugal at the moment?
So I live in a town called Cascais, which is near Estoril, which is where the old racing circuit was, and it's about 21 today. We've had the worst winter apparently in the last sort of 30 or 40 years. It's been dreadful, and it's never. We had a horrible storm in October, and the temperature's never recovered. And it's not. Don't get me wrong. By English standards, it's not being cold, but this year we had temperatures as low as 14 degrees, which previous years like 17, 18 would be the low end. But it doesn't really get that hot. Even in summer, 30, 33, that sort of number.
Okay, so not absolutely horrendous temperatures.
No, like once in a while you might hit a high number, but it's unusual and it doesn't really happen very often.
Okay.
It's 20 to 30 is where it is 90% of the year, to be honest.
That sounds nice.
It's really nice. I mean, the moving to Portugal is the best decision as a family we ever made. But it does mean that I spend a huge amount of time in the airport coming back and forth to the UK, which I can't complain about really. But yeah, Lisbon's great.
So, Chris, if people want to find out more about what you do, where can they find you online?
So please do look me up on LinkedIn. Just search for Chris Grove, but Archer Fleming website really. The other thing that I should very, very slightly plug, we have there's a website called School, SKOOL, where
Yes, I know it.
all sorts of things. We have a thing called the Exit Strategy Lab. It's completely free. All the resources are free. If you want to know anything at all about getting a business ready for sale, what people look for, due diligence lists, there's a whole checklist where you can look at how ready your business is for sale. There's loads and loads of documents in there. It's totally free to join. Please do feel free, have a poke around and look around in there. And we're never going to charge for any of this stuff, but you can see exactly what buyers are asking.
Okay, super cool. It's what Archer Fleming is at archerfleming.com or?
It is, yeah. ArcherFleming.com.
Chris, great to speak to you. Thanks so much.
Absolute pleasure. Thank you very much indeed. Cheers, Trevor.